I've done an economic strategy which will be out this morning on the Federal Reserve, and why the piece is important is that the Federal Reserve has now formally changed the way it targets inflation and how they consider inflation when they're setting monetary policy. And in discussing this, I've talked about two formal statements that they released in January, and I've talked about those within the context of the outlook for the US economy that they released after the Fed meeting in the middle of December. So what they're doing is they've always targeted, since they decided to target inflation, they've always targeted a specific level of inflation, that's 2% on the personal consumption deflator. Personal consumption deflator is how you work out personal inflation within the context of GDP. And when I've written about this, what I say is that 2% on the personal consumption deflator, because it's structured differently to the CPI, when you actually look at it over time, it's pretty much exactly the same as a CPI inflation target of 2.5%. So we have effectively got an inflation target of 2.5%, that is to say between 2 and 3, and they've got this target of 2% in the PC deflator. They're pretty much, they are exactly the same in practice. That's the first point. Now last year, an RBA changed, made the announcement, or Dr. Philip Lowe made the announcement that instead of targeting forecasts of inflation, you had to have the inflation actually achieved. So the Fed has gone a step further than that, and in this new policy, they're not targeting the level of inflation, they're targeting the average of inflation over time. And so they make that formal announcement in the statement of the 24th of January. What's important about it is that following periods when inflation has been persistently running below 2%, like now, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. So this is so the Fed can achieve a 2% inflation target over time. So what they're telling us is we've been running inflation below the target for the last couple of years. So what they're going to do now is try and target inflation, let it run hot, let it run faster than the 2% for the next 2 years, if they can achieve that. And after the meeting on the 27th of January, what Jay Powell himself said, that inflation running persistently below this longer run goal of 2%, the committee will aim to achieve inflation moderately above 2% for some time, so that the inflation averages 2% over time and longer run inflationary expectations remain well anchored at 2%. Now, when do we actually, well, what does this mean? I mean, what the Fed is attempting to do, of course, is target inflation within the context of full employment. So to find out when they get to full employment, I go back to, as I said, the outlook that they released in December. On the 16th of December, they produce, as they do every quarterly meeting, a summary of economic projections, which is the median of all the projections of all of the different Federal Reserve banks. And they said then that they thought that the US economy would grow by 4.2% this year, which is pretty good. That'll be then 3.2% the year after that. And they said the result of that is that unemployment, which is a bit over 6% in the US, unemployment in the US is actually a touch lower than it is in Australia, by the way. So it's not that high. That US unemployment will fall to 5% by the end of this year and 4.2% at the end of next year. Now, what's really interesting about the 4.2% inflation, 2% unemployment, is the level of unemployment that they believe they have to get to for inflation to start going up again. And that's, as I've talked about before over the last number of years, that's called the natural rate of unemployment. And you can judge what they think the natural rate of unemployment is by where they think that unemployment will be over time, a long period over time, because that's what they're targeting. And that's 4.1%. And so when we get into 23, they say that US unemployment is going to fall to 3.7%, which is below the natural rate of unemployment, and therefore you expect inflation to begin to kick in 23 and 24 in terms of their outlook. And so we expect to be running higher inflation in 24. They've just told us that they're going to allow inflation to run for a few years high so that they can get their average inflation rate up. So my problem about that is that the Fed can control inflation at the short rate, it can control interest rates at the short end of the yield curve, but it doesn't control interest rates along in the yield curve. It doesn't control bond markets. And if they actually start generating persistently higher levels of inflation, long-term interest rates must rise. So you get the beginning of a sell-off in bonds. And once there is quantitative easing, they are buying bonds, but once you get a sell-off in bonds start to develop, it's really hard for the Federal Reserve to stop that happening, even if they are buying bonds themselves. So what I'm saying in this is that the Fed has changed its inflation targeting policy to a longer run inflation rate. The US likely gets back to full employment in 2023. After that, higher inflation may start a bond bear market, which the Fed might find hard to hold. So what I think is that it's good that they're changing monetary policy. I understand that if inflation goes up in the short term, that means that real interest rates fall in the short term, and that means they provide more stimulus in the short term, and I understand that that allows them to get unemployment down over the next couple of years. But when they get unemployment below the level where it's going to persistently start generating inflation, and they let that run, I think they're going to have a lot of trouble getting inflation back under control, and I think that's going to generate significant problems from the bond market out in that period in 24, 25. So I think they'll be reconsidering this strategy in a couple of years' time.